Tax year end is almost here, so here are 10 smart tips to think about before the 5th of April. Now this video isn't going to go into great detail about any of the suggested tips. It's just a quick overview, quick reminder to think about some of the items mentioned before tax year end. So tip number 1, use your ISA allowance. The ISA allowance is £20,000 per person. If you don't use it before the end of the tax year, you'll lose this tax year's allowance. If you're unsure of which ISA to go for example, choosing between whether you should use a stocks and shares ISA or whether you should use a cash ISA, well, if you fund a cash ISA with whatever you can afford, you can choose an instant access cash ISA. Then it is possible to then transfer that to a stocks and shares ISA later without using later years ISA allowances. You've also got junior ISAs that you can consider for children, and there's also lifetime ISAs where appropriate as well. Tip number 2, top up your pension. Pension contributions can reduce your tax bill and build up your retirement provision, so it's a win-win situation. If you're a company owner, then you can make company contributions to your pension scheme, potentially reducing your corporation tax bill, a very tax efficient way to get capital or surplus capital out of your company. Another benefit to making pension contributions is the ability to reduce your adjusted net income. I'm not going to go into too much detail about what adjusted net income is in this video, but broadly speaking, adjusted net income is your total taxable income before you apply any personal allowances, such as your $12,570 tax-free personal allowance, but after any reliefs have been applied, such as gift aid for charitable donations, or crucially for this segment of the video, gross pension contributions, or even trading losses apply as well. So your adjusted net income is your total taxable income for the year minus any qualifying reliefs. So a pension contribution, why is that helpful when it comes to reducing your adjusted net income? Well, very quickly, any income over £100,000, any adjusted net income over £100,000 means that your personal allowance for income tax purposes, the $12,570 for the current tax year, is reduced down. Every £2 over, that's reduced by £1. That means that it could go, roughly speaking, once you get to £125,000-ish of adjusted net income, your personal allowance is down to zero. So effectively, that bit of earnings above £100,000 is costing you 60% income tax. By making a gross contribution to your personal pension, let's say for example, it can bring that down. So I could make a gross pension contribution of £25,000 if I was earning £125,000 adjusted net income, and actually that 60% income tax that I would have paid on it, I get all of that back for that contribution. In addition, for getting my adjusted net income below £100,000, if I'd qualified for the free childcare, then I lose that if I earn over £100,000. However, getting my adjusted net income down below that can get me all of that free childcare back, again saving me a few £1,000s. And finally, the child benefit higher income tax charge. So if my earnings are between £60,000 and £70,000, or one of us in the family has that, it means that we effectively lose that child benefit because of the additional tax charge. Again, a pension contribution bringing me down below the £60,000 mark can get me back my entire child benefit, or get rid of that child benefit tax charge. Tip number 3, use your capital gains tax allowance. The capital gains tax allowance is only £3,000 now per person, but if you don't use it, you will lose it. So if you have any investments, for example, outside of an ISA or outside of any tax-free wrappers, then you could look to sell some of that investment where you've made a gain to crystallise the £3,000 capital gains tax allowance, so long as you don't repurchase, for example, the same shares within the next 30 days, or the same fund if you just sold a fund within 30 days, or if you use the proceeds to purchase a different fund or different shares. That way you'll crystallize the capital gain for this tax year, so saving yourself some capital gains tax. Tip number 4, you could gift money now tax-free. So where it's likely that your estate on your death will have an inheritance tax liability, you might want to consider gifting money now using some of the exemptions that you have each year. The typical one, you can give up to £3,000 in total, and it's outside of your estate immediately without having to wait the 7 years. If you haven't used it for the previous tax year, you can use that tax year as well, potentially allowing you to give away £6,000 this tax year. If you're married or in a civil partnership, you each have those allowances available, so potentially up to £12,000 if neither of you had used your gift allowance for last tax year. Benefit of this, you get to see your loved ones or whoever you gift that money to benefit from it now rather than having to wait until your death. In addition to the £3,000 exemption, you've also got £5,000 in consideration of marriage. So where your children are getting married, you could each, if it's a married couple again, each give away up to £5,000 in addition to the £3,000 exemption. If it's grandchildren, £2,500 you can give away, and it's free of inheritance tax straight away. On top of that, you can give away as many gifts of £250 to different people as you like, but you can't use that one in conjunction with the £3,000 exemption. Plus also, if you haven't used all of your disposable income every year, so if you had income of £50,000, you only spent £30,000, then you can give away £20,000. So net income at £50,000, you only spent £30,000, you could give away £20,000. You just need to give away a regular gift each year. So to give away the regular gift from income, it doesn't have to be the same amount every year, and it doesn't have to be to the same person. That is then also exempt from your estate from day one. A point to note when you're making a gift from income is that it should not affect the donor's standard of living. If it does, then it wouldn't be exempt. Check out the HMRC guidance for any details on this. Finally, if you're so inclined, you can make gifts to political parties, or you can make gifts to charities, and these are exempt from inheritance tax immediately as well. Tip number 5, claim business expenses. If you're self-employed, check to see if you've got any expenses that you can claim to reduce your profits and subsequently your tax. Tip number 6, salary versus dividends. If you're a company director, make sure you review your income and make sure you've got the mix just right between dividends and salary to maximize tax efficiency. Don't forget, if your spouse is also a director on the company, you could consider making company pension contributions for them, or you could also consider the mix between dividends and salary for them. Don't forget, making salary payments for them, if they aren't getting national insurance contributions from any other state benefits or any other salary, then this could also help contribute towards their national insurance record. Tip number 7, claim the marriage allowance. If you're a basic rate taxpayer and your spouse has a low income or doesn't use all their personal allowance of £12,570, then you can claim the marriage allowance, which allows you to use up to 1,260 of your spouse or civil partner's unused personal allowance to offset against your own income, potentially netting you an extra £252 in saved tax for the year. Tip number 8, check your tax code. Surprisingly, HMRC can make mistakes with your tax code. A wrong tax code could mean that you're paying more tax than you need to. So it's essential. Check this, make sure it's correct. Tip number 9, for those more seasoned investors who can afford to take some risk with some of their money, or higher risk with some of their money, and maybe you've exhausted all of your other tax-free allowances or tax-free investments, then you might want to consider enterprise investment schemes, EIS, seed enterprise investment schemes, SEIS, and venture capital trusts, VCTs. These attract an income tax reducer of between 30% and 50%, so long as they're held for the minimum time frames. But you must remember, these are investments into smaller companies, and you can lose all of your capital quite easily, potentially. Seed enterprise investment schemes and enterprise investment schemes also have something called loss relief, which can offset some of the risk of investing in them even more. But like I say, these will be more suited to those who can afford to lose that money potentially, who want to diversify away from some of the other investments that they have, and it should only make up a small proportion of your overall investment. Remember though, do not let the tax tail wag the investment dog. Tip number 10, time, income and expenses. Are there any income payments or expenses that can be moved between tax years? Time them, make sure you put them into the tax year that's going to have the biggest impact for reducing your taxes. So there you have it, 10 quick tips to help you arrange your affairs and potentially reduce your tax bill. Speak to your accountant before it's too late and get these changes in place. You've now got, a couple of weeks just over until the end of the tax year to get these bits in place. Don't leave it to the last minute, because don't forget things like pension contributions. Sometimes there is also a delay for administrators or pension administrators who have lots of requests at this time of year. So don't leave it to the last minute. Get those savings in now. See you on the next video.